Welcome to this introduction to trading timeframes. By the end of this lesson, you will be able to identify the unique roles of the 5-minute, 15-minute, and daily charts, and understand why looking at multiple timeframes is essential for successful trading. In trading, a time frame refers to the amount of time that passes for a single candle or bar to form on a price chart. While the price of an asset is the same, looking at it through different time frames is like using different zoom levels on a map. We are going to explore why we don't just use one chart, but rather a combination of the 5-minute, 15-minute, and daily views to get a complete picture. Let's start with the big picture, the daily chart. Think of the daily chart as your North Star. On this chart, every single candle represents one full day of trading activity. Because each candle contains so much data, the daily chart is used to identify the major trend. It filters out the day-to-day noise or random price fluctuations that can distract you. If the daily chart is moving up, the wind is at your back for buying. If it is moving down, the overall momentum is bearish. You should never trade against the daily trend without a very good reason. It provides the context for everything else we do. Now that we have the big picture, let's zoom in a bit to the 15-minute chart. The 15-minute chart serves as an intermediate filter. If the daily chart is our map of the entire country, the 15-minute chart is the map of our specific city. Each candle here represents 15 minutes of time. Each candle here represents 15 minutes of time. Notice how 4 candles fit into a single 1-hour block, forming what we call intermediate structure. The 15-minute chart is where we look for market structure. It helps us identify levels of support and resistance. These are levels that aren't visible on the daily chart, but are too significant to be ignored on a 5-minute chart. Traders use this time frame to see if the immediate momentum aligns with the daily trend. For example, if the daily trend is up, we look at the 15-minute chart to find a dip or a pullback where we might want to enter. It acts as a bridge between the long-term trend and our actual entry point. In summary, the 15-minute chart helps us identify key levels and bridges the gap between the trend and the entry. Finally, let's zoom in all the way to the 5-minute chart. If the daily chart is the country and the 15-minute is the city, the 5-minute chart is the street-level view. Here, each candle represents just 5 minutes of price action. The 5-minute chart is where the execution happens. Because it shows the most detail, it allows us to see the exact moment buyers or sellers start to take control. We use it to find the best possible price to enter a trade, which helps us keep our stop loss small and our potential reward high. Here is an example where price bounces. This becomes our entry point. However, a big mistake beginners make is looking only at the 5-minute chart. On its own, this time frame can be very noisy and misleading. A small move up on a 5-minute chart might just be a tiny wiggle inside a massive downward trend on the daily chart. Remember, we use the 5-minute chart for timing our entries, but always in relation to the higher time frames. To bring it all together, we use a concept called multi-time frame analysis. Our objective is to learn how to combine time frames for a complete trading plan. Think of it like a funnel. We start wide and narrow our focus down. At the top, we have the daily chart, which shows us the overall trend. In the middle, the 15-minute chart helps us identify market structure. And at the bottom, the 5-minute chart is used for execution. Let's look at a step-by-step example. Step 1. Look at the daily chart. We see the price has been making higher highs for a month. The trend is up. We are only looking for buy opportunities today. Step 2. Switch to the 15-minute chart. We notice the price is currently dropping toward a previous support level. We wait for it to touch that line. Step 3. Once it touches that support on the 15-minute, we drop down to the 5-minute chart. We wait for a specific bullish candle pattern to form. Once it does, we enter the trade. By using all three, you ensure that you are trading in the direction of the big money, the daily trend, while using the precision of the 5-minute chart to get a great deal. Multi-time frame analysis reduces risk by ensuring all zoom levels of the market align before you take action. In summary, mastering timeframes is about understanding the balance between perspective and precision. Daily, the big picture trend. 15-minute, key levels and structure. 5-minute, precise entry and timing. Remember, no single time frame tells the whole story. The daily chart tells you what to do, the 15-minute tells you where to do it, and the 5-minute tells you when to pull the trigger. Think of the daily as a compass, the 15-minute as a map, and the 5-minute as a stopwatch. Take a moment to think about this. If you only looked at a 5-minute chart and saw a massive green candle, would you buy immediately, or would you check the daily chart first to see if it is hitting a major resistance level? By integrating the daily, 15-minute, and 5-minute charts, you have now learned how to perform a basic multi-time frame analysis. This approach will help you avoid the common trap of getting lost in the noise and keep you aligned with the broader market momentum. Happy trading!